If you think that you are ready to invest, but you're at the point where you're trying to figure out, like, well, where do I start? Which one do I get? And you've heard people like, buy stocks, diversify, just get an ETF. And you're like, okay, ma'am, I don't even know what those things mean. Okay, let alone which one is going to be the best for me. I want to say to you, don't worry. I got you. Today, we're going to break down four of the main types of investment vehicles. Okay, so if you've heard about stocks, bonds, index funds, and ETFs, we're going to break it down today using everyday examples so that you can figure out which one is the best for you. Let's talk about it. Hey goalies, welcome back to the channel where we keep it real about all things money, confidence, and financial success. I almost forgot myself. If this is your first time here, I'm Mia, the Coin's Confidant, and I'm all about helping you build the confidence and clarity to crush your money goals. Now, I do need a favor from you. Please hit that like and subscribe button. Feel free always. Drop down in the comments. Let me know what you're thinking while you're watching this video. Let me know any questions you have while you're watching this video, because I think that it's very important. Now, before we dive and get down deep into it, if you are still fuzzy about what a stock, a bond, an ETF, or index fund is, I already broke these down with terms and pictures and drawings and analogies and all of those things in another video, okay? I broke it down in plain English, as I always do, and the name of that video is Investing Terms You've Heard but Never Really Understood. It's part of a series I'm doing called Investing for Beginners, From Clueless to Confident, and I wanted to make this series because I've had a lot of my clients and just people that come to me, period, that want to learn how to invest, but they listen to other videos and they're like, okay, well, I don't understand, because they're still using a lot of jargon. So while I do talk about investment vehicles and strategies or whatever the case may be, I'm typically going to break them down. But I don't want to bore you with always defining them. So I was like, let me create a video that just breaks down a lot of terms so that you can understand them. And then you have that video to continue to go back to for reference. So hopefully that video is very helpful. I do want to remind you also, this is not investment advice. I am not a financial advisor. I'm not here to advise you on what to invest in. I am here providing information and education, because that is one of your biggest weapons when it comes to fear. A lot of the women that I help, they typically have a fear of investing or around investing. And I've always felt like education is one of your best weapons to combat fear. So with that, I'm like, let me create a series. So far, I've gotten a lot of great feedback about it. If you have other videos about investing that you want me to create, definitely drop it down in the comments. Let me know. Make my life easier where I don't have to look for content. Okay? It falls right into my comments. Let me know. Help me help you. With that being said, I am going to drop a link to the playlist in the description, as well as I'll link a video to the playlist at the end of this video so that you have it for reference. Okay, now that we got that out the way, let's get into what we are really here for. How do you choose? How do you figure out what's the best investment for you? So I'm going to give you an image to imagine. So imagine or picture this. You're standing in front of a buffet. Okay, it's an investment buffet, y'all. Now, you have these options. You got stocks over here. You got bonds. You got ETFs. You got index funds. And they all sound like they're fine, but are they all for you? And they're not all for you, especially not right now, like immediately. Okay. So we're going to compare them, and we're going to look at 4 different areas. Okay. So the first area is going to be risk, which means how much risk are you taking with your money? A lot of people that I know have a fear of investing is because they fear that they're going to lose all of their money. That's what I've experienced. That's what my clients have told me over and over again. So that's got to be the first thing we're going to tackle. We're going to tackle the level of risk dependent on the type of investment. Okay. Then we're going to look at return. That's the second thing. We're going to look at the second area. Basically, how well am I going to get a return on my money? Like, if you ever heard people say, what's the ROI? What is the return on investment? How much of my money, if I put in $1, how much am I going to get back in addition to that? How well will my money grow? That's the reason for the season. We're not investing for our health. We're investing because we want our money to do some work and we want our money to grow. The third one we're going to be looking at is simplicity. How easy is it for me to invest this way? How simple will it be for me to use this as my investment strategy? And then fourth, we're going to look into cost, because as we all know, all coins matter. Okay? We need all coins on deck, because in this game, when you are working a job, you need to use that money, no matter what you're doing, to bring in money, to be honest. It doesn't matter if you're working a job, if you drive an Uber, whatever it is you are doing. You want to have that money, taking some of it to create more money for you. Because if not, you're a part of a cycle. You just work, you get money, you pay bills. You work, you get money, you pay bills. You have to use that money and create a system to help you achieve your goals. Okay. I'll get off my soapbox. Now, another thing I want to remind you of is you're not trying to find the best investment, okay? You are not trying to outbeat the market. That's not what we're trying to do. You're trying to find your lane so that you can stay in it, you can master it, and then decide what other lanes you need to be in to accomplish your goals. So we're going to start off with stocks. So stocks tend to have higher potential for returns, to be honest. But they also have a higher risk. Now, when you own a stock, you own a slice of a single company. So if that company does well, then great. Your money does well, the value of your money goes up. But if that stock or that company does poorly, then you're going to lose your money, okay? And you're going to feel it. And so for this reason, it's typically suggested that you don't put all of your money into one stock. You don't take, if you say you won the lottery and you had $30,000, you don't take all $30,000 and put it on one stock, because if that stock fails or if that stock has a problem, all of your money is going to have a problem. And we don't like that, right? We don't like that at all. So with that being said, that's why typically you want to diversify your money and spread it around to different type of investment vehicles. And that's why I wanted to make a video giving you options about 4 of them. Let's go. Now, when it comes to stock, how much risk are we taking? It's going to be medium to high risk. Your return potential is high, but it can be bumpy and a little volatile. If the CEO gets caught doing one thing, that can strongly affect the value of the stock. We've seen it happen before. We've seen it happen with different companies. We don't have to get into details of which companies, but we've seen it happen. So that all your money is in that one stock, then you have to be mindful of that. If any of your money is in that one stock, it's going to go up and down. It's going to be bumpy, but when it's up, it's great. If it's, you know what I'm saying? That's what it kind of is. As far as simplicity, it depends on how deep you really want to go, because when you're investing in individual stocks, you have to research the individual stocks to choose which stock you want to invest in. As far as cost, you can buy your stocks as fractional shares, which basically means, like, if the stock costs $100, you might be able to buy it for $30. So you didn't buy the full stock yet, you bought a fraction of that stock. And so you can continue to put more $30 and more $30 until you have $100, at which point you will have the value of one complete stock. Okay. So you don't want to have a whole portfolio with individual stocks. I mean, you can if you want to, but it's going to take you researching all of the stocks within that investment portfolio. And so that takes time, and it takes a lot of knowledge, educating yourself, things like that. Next, we're going to talk about bonds. So when it comes to bonds, As I said in my previous video, bonds are loans. So you're literally loaning your money in exchange for someone paying you back your money plus interest. And bonds are way more predictable than stocks are, but they're slower to grow, which is important. The risk when it comes to buying bonds is low, but that means that the return is low, because we've all heard the term, the higher the risk, the higher reward. So if the lower the risk, the lower the reward. But for a bond, it's going to be steady. It's going to be steady growth. It might be very, very, very slow, like a turtle, but it's going to be steady growth and continue to grow. So as far as simplicity rather, it's very simple, especially if you're using bond funds. So kind of like index funds, but it's a fund that has nothing but bonds in it. Okay. Cost, usually the fees are pretty low, especially if you get like bond ETFs or index funds. Okay. Of course, which brings me right into the next ones, index funds and ETFs. Now, these two, most beginners start here because they are groups put together. It's not you investing in one specific stock or one specific bond. It's like automatic diversification, because when you buy one, you're automatically investing into multiple things at once. And again, I broke this down. I even had my little whiteboard for y'all and drew trees and gardens and all type of things to make sure that you were able to walk away with a better understanding of how these things work. So feel free, go look at that video, watch it in its entirety. And if it's a term that you don't know that I don't have on the list, like I said, put them in the chat, and rather the comment section. And as I build them, I'll make more and more videos into this thing. We can have 50 videos. If that helps you understand investing better and helps you feel a little bit more confident to take another step, that's the goal. And if you do use these videos, and because of these videos, you decide like, oh, you feel a little bit more comfortable with it, and you go and you start investing and you start excelling and doing well, please tell me. Don't be silent. Let me know so I can celebrate you. Okay? All right. So index funds and ETFs, like I said, are typically where beginner investors will start, because they give you instant diversification, which basically means if instead of betting all of your money on one company, you're essentially spreading your money around. So you're spreading around across hundreds of companies. And so they're affordable, it's low maintenance, and you don't need to know how to pick stocks to pick an index fund or ETF. It's less research, because it's not like you have to go research all the stocks within there. You just need to research the index fund or ETF itself. And you still get access to investing in hundreds of companies. Tell me that don't sound better. I'm just saying, if you knew it sounds better to me, it would sound better to me. I'm just saying. So I also share with you what is the difference between an ETF and an index fund. So an index fund, it's only going to trade once per day, while an ETF, which ETF stands for exchange traded funds, it trades like a stock. So that means you can buy it, sell it throughout the day. It's not like the index fund where you only can do it once. Okay. As far as risk, the risk for them is going to be lower than stocks, but it's going to be higher than bonds. Receiving a return on your money is pretty solid long term. It's very simple to invest in, super low fees, especially compared to mutual funds, because mutual funds are very similar to index funds and ETFs, but they're carefully curated based on they're carefully curated by someone. And so obviously that person needs to get paid. That person wants to get paid for their efforts of carefully curating this, growing, thriving mutual fund. They want to be compensated for their time and their effort and their education. So a mutual fund is typically more expensive. So the question is, which one do you want? Now, before you answer that question, I want to ask you some questions. And these questions will help you get a better idea of which one might be for you. And of course, listen to this video as many times as you need to. But we're going to walk through just a few quick questions, and these should help you figure a little bit more out which one is for you. First question, do you want to be hands-on or hands-off? So if you love researching stocks and companies and finding out information and all about them, you might enjoy picking a few different stocks. Like if you want to invest without obsessing over it though, index funds or ETFs are going to be your best friends because you don't have to do that. Number two, what's the risk tolerance? How well are you with taking risks? How okay are you with seeing your balance drop temporarily, or does that make you anxious? Does it make you freak out to say like, oh my God, I lost $100? Because we have to be realistic and understand that there is a possibility of you losing your money. You may not lose all of your money, but it's going to be times where your money goes down and it goes back up, and it goes back down and it goes back up. Like it's like gas prices. So you ever see how the gas station in your neighborhood, the price of gas goes up, it goes down? Wait a minute. Yesterday it was just, that's what the stock market does. So you have to get comfortable or more comfortable with seeing it go up and down. The goal is over the long term, over a year, 5 years, 10 years, that it goes up. Okay? Stocks, that's why stocks can be a wild ride. Bonds are pretty chill. ETFs and index funds, they're kind of like the middle ground, I would say. So, third question, what's your goal? Like, what's your why? Why are you doing this? Why is this important to you? If you are building long-term wealth for maybe retirement, a low-cost index fund or ETF, they'll give you growth with less stress. But if you need more stability, like you're closer to retirement and you're going to need your money sooner rather than later, bonds might help you balance out your portfolio and minimize your risk. Number 4, what's your time horizon? And so the time horizon is basically the amount of time in between now and when you would be using this money or retiring, which is going to depend on your age, your goals, your plans, all those good things. The longer you can leave your money in the market, the more risk you can usually afford to take. So if you can leave your money in the market for another 20 years, you won't be retiring or taking that money out for 20 years, you have the ability to ride the wave and be okay with the dips, and because it's going to go back up before you would touch your money. Now, I will say this again because I feel like it's very important for you to like etch in your brain. You don't need to pick the best investment. That's not the goal here. You just need to pick one or two or three, whatever, that works for you right now. And you also need to know that once you pick it, it can change. You can change course as you grow and learn. When you know better, you continue to do better. This strategy is not set in stone. It's a means for you to get started. Okay? This is your starting point. Check out my next video. So next we're going to be talking about market dips, how to understand them, the volatility in the market, how to stay calm when the market is tripping. That's the best word I got for you. Until next time, keep showing up for yourself and crushing your money goals.